Hello, everyone. Welcome to my presentation on conducting sensitivity analysis in capital budgeting and incorporating project risk. My name is Casey, and today I will discuss the qualitative and quantitative steps necessary for a thorough sensitivity analysis and how project risk can be integrated into capital budgeting. We'll start by addressing what is a sensitivity analysis. According to Investopedia, it is a technique to study how various sources of uncertainty in a mathematical model contribute to the model's overall uncertainty. In other words, a sensitivity analysis identifies how changes in one variable impact a dependent variable within a specific set of assumptions. Companies use sensitivity analysis to identify opportunities, mitigate risks, and communicate strategic decisions to management. Sensitivity analysis plays a key role in capital budgeting because it allows a business to evaluate the potential impact that certain variables will have on their investment decisions. It allows key stakeholders such as managers, owners, or investors to understand the risk or level of uncertainty associated with capital projects and whether or not they are financially viable. It also identifies what variables have the greatest effect, which may allow for mitigation to be implemented, such as controlling cost of goods sold by negotiating favorable pricing with suppliers. To conduct a sensitivity analysis, we'll start with these qualitative steps. First, identify key variables that significantly impact the project but are harder to quantify, like regulatory changes or market trends. Expert opinions, surveys, and brainstorming groups can be used to uncover or identify these variables. For example, experts may use survey insights to predict shifts in consumer demand based on upcoming legislation. Next, determine the base case scenario, which is the most likely set of assumptions for the project. Then, define the range of variation for each variable, such as a percentage increase or decrease from the base case. This should be based on historical data and expert forecasts to ensure realism. Finally, analyze scenarios by adjusting one variable at a time while keeping the others constant. For instance, see how a 10% change in sales volume impacts project outcomes like net present value or profitability. These steps provide clarity on the project's sensitivity to key assumptions, helping to prioritize risks and make informed decisions. Now, let's dig into the quantitative steps required to conduct a sensitivity analysis. We'll start by pinpointing the variables that have the most significant influence on the project's financial performance. These might include sales volume, production costs, discount rates, inflation rates, or cost of goods sold. With these variables identified, we'll develop a comprehensive financial model that incorporates all relevant data and assumptions. This model serves as the foundation for analyzing the impact of variable changes. Tools like Excel or financial software are commonly used for this purpose. With the model created, input base case values into the model for each variable. These are typically the most likely or expected values based on historical data, market research, and expert forecasts. This step sets a benchmark for comparison. From there, taking one variable at a time, we'll make adjustments within a predefined range, such as increasing or decreasing sales volume by 10%. During this step, all other variables must remain constant to isolate the effect of changes in the variable being tested. As variables are adjusted, we'll record the impact on key financial metrics such as net present value, internal rate of return, and payback period. This helps quantify the sensitivity of the project's outcomes to changes in assumptions. Finally, compare the results of each scenario to determine which variables have the greatest impact on the project's financial performance. Create best case, worst case, and most likely scenarios to provide a range of potential outcomes and guide decision making. A tornado chart, as pictured here, is a visual representation of which variables have the greatest impact on a project's key outcome, such as net present value or internal rate of return. By following these steps, we gain critical insight into how variable changes affect a project's feasibility and can prioritize areas for risk mitigation or further analysis. To ensure a well-rounded approach to assessing project risks, it's crucial to integrate both qualitative and quantitative insights. If we break this down, We'll start by leveraging qualitative analysis to provide the context and depth to identified risks. This includes gathering expert opinions, analyzing industry trends, and reviewing historical data. Next, use these qualitative insights to refine your quantitative models. For instance, if expert feedback suggests that production costs might rise due to supply chain constraints, adjust your cost estimates in the financial model accordingly. This improves the accuracy of the analysis and ensures the quantitative data reflects real-world conditions. By integrating these perspectives, we gain a more holistic view of the project's risks and opportunities. This robust analysis supports more informed decision-making, helping us identify projects that strike the right balance between risk and return. This integration of qualitative and quantitative insights ultimately strengthens our ability to evaluate risk comprehensively and choose projects with greater confidence. Let's discuss a practical example to show the use of sensitivity analysis in capital budgeting. In our case study, we're evaluating a project to develop a renewable energy plant. For this case, we have identified key variables such as the initial investment that is required, the projected energy sales, and the discount rates used for valuation. Among these, discount rates play a crucial role in determining the present value of future cash flows. For sensitivity analysis, we evaluated how varying discount rates impact the net present value. For instance, if the discount rate increases from 8% to 12%, we observe a significant decrease in net present value, reflecting a higher risk and reduced project attractiveness. On the other hand, a decrease in the discount rate to 6% results in a much more favorable net present value, signaling lower risk and enhanced project viability. Based on this analysis, we concluded that at a 10% discount rate, which was our base case scenario, the project still remains viable. However, it's crucial to factor in a risk buffer to account for potential increases in market interest rates, which could push the discount rate higher. This case study highlights how sensitivity analysis helps us understand the impact of variable changes like discount rates on project outcomes. In conclusion, sensitivity analysis is a valuable tool in capital budgeting that helps in understanding the impact of changes in key variables on project outcomes. By following the qualitative and quantitative steps, we can identify critical variables, assess risks, and make informed decisions. Incorporating project risks into the analysis provides a more comprehensive view, helping us to balance risk and return effectively. Sensitivity analysis ultimately supports better decision-making and enhances the likelihood of project success. Here are the references used in my presentation for further reading. Thank you for your attention, and I hope you found this presentation informative.